All right, welcome to Trading Mindset. With me is Dr. Brett Steenbarger, trading coach, a professor, a trader, an author. Some of the best trading psychology books. I have one of my personal favorites right here, Enhancing Trader Performance. Uh, Dr. Brett, it is such a pleasure to have you with us. Thank you very much for spending some time with us. How are you doing today?
Doing well. Thank you for having me. It's a good time to be talking about trading psychology because so much is going on in markets.
There certainly are, and I know a lot of folks are really excited to hear what you have to say about trading in volatile markets, trading at all. We've got some really good questions. We're really looking forward to having this time with you today. Um, we're going to kind of, I think, start with just kind of a general overview of trading with volatility or in volatility. Do you want to just go ahead and get started on that, and then we'll get down to the questions?
Sure. Yeah, so let's do a little overview of what's been going on because the people I work with who have been successful in the recent market have been aware of what I would call the big picture and then zooming into the small picture. So they are looking at if they're trading equity markets, if they're trading, for instance, the ES futures, they're looking at the asset classes surrounding stocks. So they're looking at the US dollar, they're looking at interest rates, they're looking at the changing shape of the rate curve. Are we pricing in increased odds of recession? Are we pricing in a weaker and weaker and weaker economy vis-a-vis the dollar and its various crosses? Is the or dollar in other markets losing ground to perceived safe havens like gold? So they're looking at lots of different markets. They're looking at commodities. Are we seeing more signs of weakness? And of course, if there's going to be weakness in the economy, then that affects the valuations of companies and that affects how interest rates will behave in the future, given the concerns of the central bank, the Federal Reserve. The problem we have right now in the big picture is that on one hand, we have signs of a weakening economy, and on the other hand, we have signs of tariffs that could be inflationary. And so you could get a situation where interest rates have to stay high because of inflation. The Federal Reserve is not as free to lower interest rates, which would make it hard to stimulate the economy, which would make it hard to get out of recession. That the term for that is stagflation, and it's something we
Inflation. Yep.
experienced in the 1970s when markets were quite weak. So these are things on the radar, big picture wise. And so on a day like today, the people I work with are looking at, how is the US dollar behaving? How are interest rates behaving? What stories are they telling? If I'm seeing weakness in stocks, am I seeing signs of weakness in other asset classes that tell me this is being priced into the market? So that's big picture. Small picture, what I'm finding is that with the increased volume and volatility of the market, those two tend to go hand in hand,
Hmm.
that we're getting a lot more price action and that it is difficult for short term traders to adapt to that. So I'll give a very concrete example, something I wrote about in
Uh-huh.
my blog, Trader Feed. I found that I had to adjust all of my charts. Whereas
Really?
I used to look at 1 minute charts. Let's say I'm looking at the ES futures or the micro E-minis, the MES. Let's say that I'm looking at the NYSE tick, the number of stocks trading on upticks versus downticks at any particular time, because I want to see the balance of buying influence and selling influence in the overall stock market. Well, the 1 minute bars were not doing it. In order to catch the rapid movement, I ended up adapting to 15-second bars.
Wow.
Yeah, that's what I say.
Huh.
So, yeah. And so, sure enough, many of the patterns that I was familiar with the 1 minute bars were showing up, but at this higher frequency because there was just so much more volume, so much more movement, so much more volatility. As a result, changing all my charts, the indicators, the things I look at, remain the same, but on a different scale. So
Right.
I ended up getting many more signals because I'm drawing more bars. And
Sure.
so that means I have to process quicker. If I did not make that adaptation or those adaptations, then it felt like I couldn't keep up with what was going on. And then that started to affect me psychologically, emotionally.
I'm sure.
So the best way for me as a psychologist, but also as a trader, to adapt to these markets was to adapt my trading style and the pace of my trading. And once I drew the more bars, so to speak, the patterns were playing out, albeit quickly, and I could make that adjustment and be very tactical in, getting out. That allowed me to feel more in control. That allowed me to feel better psychologically, emotionally. So the takeaway here on the small scale is that by understanding what's going on second to second, minute to minute, even as you have a big picture, you end up feeling like things make more sense, and that helps your psychology. I wasn't trying to work on my psychology to help my trading. I was adapting and adjusting my trading to help my psychology. That is the single most important lesson I can share with those tuning in.
Well, thank you very much, Doctor. I'm posting your blog spot on our link right now, folks. Definitely
All right.
check out this blog spot. There's so much really great stuff on there. So, folks, we are right at that 5%. We're below it in the Russell. Be careful. Right, right around that 5% level. So traders be careful about that. LFA, XFA and live funded accounts don't trade below 5% off the settlement price. I've got those on my charts right here. These white lines represent those levels. And
Good.
sorry to interrupt you, doctor, but
No, no, no. This
how
is important.
how do you look at a 15-second chart? It would give me heart palpitations.
Right, right. Well, um, the main chart that I use for the futures contract actually is a chart not in time, but in volume. I think I've mentioned that in the past. And so what I ended up doing there was instead of each bar representing 5,000 contracts traded, each bar represented 1,000 contracts
Uh,
traded. So what you're doing is you're getting many more open, high, low, close, open, high, low, close, open, high, low, close.
sure.
You're drawing more quickly, but I find that if I can just absorb myself in what's going on and look for the patterns, for example, one pattern that I look for that was very successful uh, before this big rally was where you see selling and selling and selling and selling. The NYSE tick is going really negative, really negative, really negative.
Mhm.
You're getting red bar after red bar after red bar on those 1,000 contract bars, and the market can't make a new low. So right away, even though I'm keeping up with the quick bars, I'm seeing the
Uh-huh.
bigger picture of the chart and selling, 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 selling. We can't make a new low. And the tick is like negative 800, negative 900. So there's tons of selling, broad selling. Can't make a new low, can't
Uh-huh.
make a new low, make a new low. And what goes through your mind, if you've traded these things long enough, is these people are going to be trapped. These
Yeah.
sellers are expecting the market to go down, 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 and it ain't happening. And what's going to happen if we get some buying coming in? And sure enough, is like around 1:29 Eastern time. Sure enough, all of a sudden we get this buying, and because someone put something on
Right.
social media. So we get all this buying, and the tick jumps to over plus 1,000, and then it comes down, and
Wow.
again over plus 1,000, and again over plus 1,000, and the market rips higher, and all these people have to cover their shorts. But the setup was occurring before that announcement came out that, oh, we're going to delay for 90 days.
Right.
So, by looking at the short term action and putting it in a larger context, things can make sense. But that takes practice. I'm a little
Right.
bit older than most of the top step traders, I suspect. I've been doing this for years. And it's that practice, that repetition at the end of the session, going over each of the charts. What did I miss? What were the patterns? Looking at it again, 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 because so much is pattern recognition. And
Mhm.
when you keep looking at the charts and keep looking at the charts and internalize all of that, eventually it becomes part of you and you can see it in real time.
When you say internalizing, I mean, you can stare at charts for 10,000 hours and never learn a thing. How do you internalize what you're taking off those charts?
Yeah, it's a really good question because it's not a matter of just staring at charts, but rather making sense of them. And so I'm looking carefully, replaying bar by bar by bar by bar. What happened here? What were the sellers doing? What were the buyers doing? How did that affect price? And looking to see how those patterns were evolving and noticing how that fit into a larger picture. So I'm not just staring at the charts, I'm seeing how it all came together. The pattern was how things unfolded. And if you see those patterns enough times,
Uh,
then you're more prepared to be able to act on them in real time.
more intuitively.
Yes, yes, because pattern recognition is by definition fast thinking. If you think of the Daniel Kahneman distinction between fast and slow thinking is deep thinking, it's reasoning, it's analyzing. This is a much quicker process where you're putting things together and saying, aha, I've seen this before. This is what that means.
Almost like instinct. I guess it would
If you,
get to that at some point.
yeah, that's a great point. At some point, because if you rehearse enough, if you look at enough patterns and charts, then it becomes instinctive. It becomes part of you. As a psychologist, I've seen many patterns in people's lives. People talk to me about their problems, their issues, and those problems are also patterned. There are themes that run through people's lives, and you've worked with enough people that you've seen these themes again and again, and so it all starts to make sense to you. Light bulb goes off, and that tells you how you can help the person.
All right. Let's jump into our first question, if that's all right, Doctor.
Oh, absolutely.
Okay. This question comes from Jay. So, with this volatility, you're going to have some traders that may have had their biggest days ever recently, either winning days or losing days. How does a trader how do you suggest dealing with that mentally? These environments can really skew one's perception of money.
Yeah, yeah. You know, I'm thinking about a trader who I interacted with recently who had a really, really good day, best in a long, long time, and did an extensive review of what they could have done more, what they could have done differently, what they could have done better. In other words, they wanted to make sure that they came away with learning lessons and didn't just go away, feeling great about what they did, but there are
Sure.
still things they can learn. I did really, really well, but I could still be better. And I think that's a good mindset. Um, the other mindset that's very helpful is crystallizing what you did well and how you did it well. If I had my best day, I must have had some best trades. Well, what did I do for those best trades? How did I come up with the idea? What was I looking at? How did I enter? How did I manage the positions? And you jot down learning lessons from what you did well, and what you jot down can become a checklist for what to do tomorrow. So, that's a constructive approach. I
Yeah,
sort of like
that's great.
I sort of like the spiritual attitude of this too shall pass. And when things go really badly, it doesn't mean that everything's going to go down the toilet all the time. And when things go really well, it doesn't mean that you've suddenly figured out everything in the world. And so to recognize that this is great, made money, but tomorrow I start with zero P&L and I have
Zero.
to do the right things.
Great answer, um, Dr. Brett. So, in dealing with that mentally, whether it's a big winning day or a big losing day, look at it from outside yourself. Review what you did. Take a look at all of the things that you decided to do. Why? What you could have done better. What you can improve on instead of just dealing with it mentally without looking at it mentally. I really like that
Yeah,
answer,
learn
doctor. Folks,
from it. Yeah, if a trader
yes,
just said to themselves, "Yeah, I had a great, 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 great day. Wonderful. What are the three things you did today specifically that you'll make sure you do tomorrow?" Just that alone makes it constructive.
excellent, excellent. Folks, we are beyond that 5% limit. If you are on a live funded account or an express funded account, be flat. And let's wait this out. And as Dr. Brett just said, this too shall pass. Um, Doctor, I've got a question here. If a trader of some experience avoids highly volatile periods in the markets due to past negative results, could it be it's just not their market state? Or if she feel and what if she feels guilty about missing out on it? So this trader apparently has some experience, doesn't like volatile periods, avoids it, but maybe feels a little bit guilty about missing out on the opportunities.
Yeah, I think that's a great observation by the person asking the question. And if you're not familiar with how to adapt to the volatile conditions, stepping back and not putting capital unduly at risk is prudent. However, I'm a big believer in gaining experience, gaining experience, gaining experience, and then markets change and you go back to being a noob. You go back to being a beginning trader.
Yeah.
And so,
Yes.
I would say if the markets become really volatile, so I was doing well when the VIX was 15, then it became 20, then it became 25, and then the VIX jumped over 30, and I'm uncomfortable with all that movement. I would go back to observing the market and identifying how do the patterns evolve. the things that I look at when the VIX is 15, how are they playing out in the more volatile market? And I'd look for patterns, look for patterns, look for patterns without putting on any risk. And pretty soon, I think things will start to make sense. Like I said, I had to change the x-axis of my chart to some degree to get to that point, but things start to make sense, and then you feel more comfortable taking some risk.
So when the market state changes, whether it's volatility, direction, range bound, breakout, anything like that, I find that a lot of traders kind of get their gears stripped. There's a change in the market state, but it takes time for people to make that change. Maybe it's frequency bias, something like that. Uh, but when you're recognizing a possible change, maybe stepping back, learning from it, and then being able to recognize that a little bit faster the next time would be the right thing to do. Then, right?
Yes, and recognizing it faster, I like that idea, Hogue. And you can do that by looking at volume because volume correlates with volatility. And if the volume is increasing, if the volume today is much higher than the usual volume at that time of day, then you know that there are more participants. That's going to move the market more. It's going to make for a different market. And it might be different enough that it does make sense to treat it like a different market and learn patterns anew. If you told, let's say, an S&P trader, you told them, "Oh, I'm sorry, TopStep has a new policy, you can't trade S&P, but we're putting you in natural gas futures." What the heck? What would you do? Well, of course, you would have to step back and observe natural gas futures, and you'd look at Natty, and you'd look at Natty, and you look at Natty, and you look at the patterns, and eventually you'd get to the point where you would feel okay about putting some risk on. When market, when your market gets much more volatile, it's like trading a different asset class, a different market altogether, and that takes adaptation.
I can't imagine having to change a product on the fly like that. Well, you're not. We can't trade at ES anymore. Let's go trade natural
Right.
gas. Natural gas is scary.
Yes, I work with people who trade some of those commodities, and it's a different beast.
Yes, it is. I got a question here from D. How do we center ourselves when things start flying around and FOMO kicks in? Would you have any kind of practical exercise that would help with that? Would beyond amazing.
Yeah, yeah. The idea of centering oneself is really important, and getting caught up in the market volatility would be the opposite of centering oneself. In the example I gave with my own trading, what I had to do to center myself was step back and make sense of how patterns played out under the more volatile conditions. And then I could return to the market without the emotional reactions, without FOMO, and so forth. But it takes that stepping back to make sense in order to adjust. Let's say I'm driving my car and I'm hoping to get to my destination at a certain time, and suddenly it starts snowing and the roads become icy. Well, I'm afraid that I might be late to my destination. And so I keep on the gas pedal. Well, that's not going to go
Mm,
well.
no,
So, what I need to do is adjust to the conditions, and that's going to mean an adjustment of expectations. But once I process the change and adjust to the conditions, then it's no longer an emotional event for me. I know that I drive at 30 miles an hour rather than 50 miles an hour when we have
you'll get
snowy, slippery road conditions. Having worked in Syracuse, New York for many years, I know this.
Yes. So to get yourself back to center, it's just take a step back. Maybe, if there's something that happened, maybe you're carrying some venom in your veins for something that has happened or something that you have missed. Step back, let it go, find yourself back to center, and then re-engage.
Yes, because what you're missing out on is a reactive trading opportunity, so to speak. You're missing out on reactive trading, and that saves you a lot of money.
Great, great answer. Thank you very much, doctor. Um, what would you say? This is from Vince. What would you
Mhm.
say goes through the majority of traders' minds during times of high volatility? And how do you counteract some of the bad things that probably go through your mind?
Perfectionism, I would say, is the number one bad thing because you see so much movement, you think that you should be catching it all. And that perfectionism is what leads to the FOMO that we were talking about in the previous question and could lead people to overtrade. And so, what you want to do is step back and say, okay, it's more volatile, there's more volume. That means that a different set of participants is in the marketplace. If we get tick readings of plus 1,000, so 1,000 stocks all at the same exact time are trading on
Hmm.
upticks. Well, that's not happening because a bunch of day traders have traded all the stocks. That's happening because
Uh,
large institutions are buying baskets of equities and doing it in a coordinated way. And so by tracking who's in the market, then you can step back and say, all right, what's going to tell me that they're trapped? What's going to tell me that they've been selling and selling, and the selling is becoming exhausted? They've been buying, buying, the buying's becoming exhausted. What will tell me that the buying activity can't push us to a new high? So I look for overbought levels at lower price levels. What tells me that we're getting selling, selling, but the oversold levels short term are happening at higher lows. Those are clues that tell you when people are trapped, and we can be much more selective, much more strategic about when to enter and why to enter. And the volatility itself will give us good movement on those ideas.
okay. Thank you, doctor. I think that
You have
really
to be
goes nicely
grounded
in.
in what is, you have to be grounded in what is signal versus noise. For you and your
Right.
trading,
Okay.
what is signal?
Excellent. It kind of goes into this next question, which is in the current market conditions we're in that are very headline driven as it was yesterday. But I think I
Unbelievable.
know you the answer to this question, but I still want to hear your response to this. The current market conditions we're in that are very headline driven. Do you think it's beneficial to wait for the volatility to start to enter the trade? Thought process being once the market knows what it needs to do to react, can we just follow the trend? Now you were talking about yesterday near those lows, selling coming in and not being able to make new lows. If you took that trade, you were able to be in before that big pop happened.
Yes, yes, and or very early in that up move. In other words, the selling was exhausting itself before that announcement came out. And you can see that on any chart of NYSE tick versus the E-minis. But if you noticed it and then suddenly you get a surge of buying, then that's new activity,
Now you're
new
in.
participants coming in. And so I can get in and I'll get out at the low of that bar. In other words, if this is starting a new regime of buying, then we shouldn't go back to make a new low from that bar. You treat it like a breakout trade, in other words.
Hmm.
We break
Yeah.
out of a range
So
on good volume,
yeah,
you shouldn't go back in the range. If you go back in the range, you stop out.
you step out. Sure. So
Yeah.
basically, wait, kind of looking for the breakout or the volatility to begin to get into that in that direction would be a viable strategy in this
It's looking
regard.
for the
Correct.
volatility. It's looking for the volatility, but it's also looking for the balance between buying activity and selling activity, which is why in my own trading, uh, I never just look at price action charts. I always have to have indicators of buying and selling activity that tell me that how many stocks are trading on upticks, how many on downticks, and I have other indicators as well that give me that information of the balance between buyers and sellers. When that shifts, and that's accompanied by volatility, let's
And
go. Yeah,
and you're going. What
and you're going.
indicators do you use, doctor?
Yeah, so if people want to check out my blog, I do share that on the Trader Feed blog. One of the
Here's the
indicators,
link to that, folks. It's in the chat.
yeah, it's traderfeed.blogspot.com. And there are lots of different posts that you can read. But John Ehlers, the person who's done quantitative research on cycles in markets, developed an adapting moving average set of indicators. And so it's based on the basic technical principle of short term moving average crossing above long term moving average, and that's a buy signal. Short term moving average dipping below the long term moving average, that's a sell signal.
Mhm.
But the adaptive moving average adjusts the length of time for the short term and the long term moving averages based on the dominant market cycle. So when you get frequent cycling activities, you'll get more of those overbought, oversold signals, more of those crossovers. So it's adaptive in that sense. I
Hmm.
use the adaptive moving average on three different time frames, and I look for those crossovers to line up on multiple time frames. And then I look to see on those occasions, how does the balance of buying activity and selling activity play out vis-a-vis the NYSE tick, for instance. And that tells me that the balance has changed just as the moving averages has changed, and that provides some pretty nice opportunities. It also pushes me to wait until all those things line up before making a trade. Now they'll line up more quickly when they'll line up more times when you're drawing more bars, because
Sure.
of the volatility of the market. But you still have to wait for the setup to play out, which is very helpful in preventing over trading.
All right, doctor. I it's unfortunate that the markets are in this condition right now. We got very close to that 7% CME limit in the equities. They're back off of there, but still hanging around that 5% level. So funded traders, XFA traders, you might want to think about just holding off for a little bit here. I've been keeping one eye on these things. No limits hit yet, and they have come off where they were. So we're back, basically 5% off the settlement price. So right now, we may be in pretty good shape. And again, I apologize, doctor, for kind of turning to that, but we just got to let our
No,
traders know.
that's the important stuff going on for people who are trading right now. Those are
Absolutely.
the
Thank you.
crucial things.
All right.
Hogue, I've got an
So,
eye on the charts too. So if I see something and you
okay,
guys are locked in, I'm kind of the eyes in the sky right now. So I will jump in if it needs to be said. So you guys just do what you got to do.
awesome.
That's great. Thank you.
Awesome, Gabe. Thank you. Okay, doctor, this is from a doctor. It's a little bit
Wonderful.
lengthy. I'm going to try and shorten it a little bit, but he says, as a doctor, he's been trained to stay calm under pressure, whether it's in a clinical emergency or during a complex diagnosis. That kind of stress feels structured with clear protocols and some level of control. When I'm trading, especially during periods of high volatility, triggered by sudden events like Trump tweets or geopolitical headlines, the stress feels very different. It's more chaotic, unpredictable, and emotionally reactive. Find myself getting mentally hijacked, either freezing, overreacting, or second guessing my plan. Why do these types of stress feel so different, even though they're both high stakes? How can I start to understand these different stress triggers better? And what strategies can help me build the kind of mental resilience that keeps me grounded when the market becomes irrational or emotionally charged? It's a
Yeah,
lot.
great,
It's
great.
a lot to unpack there. Um,
Yeah, great question. It's a
Yes.
relatively easy question for me to answer because I teach in a medical school, and and so uh, I can see how physicians in stressful areas like in emergency medicine, how they develop those protocols that the doctor mentioned, and how they practice those protocols and observe cases and participate in helping out the attending physicians before they ever are responsible for patients themselves. So there's a prolonged period where you are an apprentice and you are watching things being done, you're helping do things, and that makes the stressful situations more familiar. And when they become more familiar, they're less stressful. That same process of training occurs in military special forces, for example. And so the reason that well trained special force troops don't just freak out when there's an enemy attack is because they have rehearsed that again and again and again and again. And after, then after it all occurs, there's an after action review and they learn the lessons. They can do it in simulation. So practice gives the level mindset. Familiarity is what takes away the emotionality. And so this is all a long winded way of answering the doctor by saying you need to train yourself in trading the same way you were trained in medicine. You need to develop protocols. You need to observe. You need to have rules set down, checklists uh, made out so that you know what to do and why to do that. And sure enough, when you develop those, you'll know what you're doing and why you're doing it. And it will feel less reactive, less stressed, less emotional.
Preparation, practice, and a checklist. Protocols. The doctor probably doesn't have the same protocols for trading that he does for practicing medicine. Great answer.
Yeah, let me just mention one thing real quickly. When I first learned trading, there were certain indicators I was interested in, and I would print out charts. This was back in the day, old style printers. So I would print out charts of the market and all these different indicators. And at the end of the day, I would line up the charts and see how the price action occurred and see how the indicators behaved. And I would look for the patterns. Day after day after day, I did this for a full year before I ever placed a trade. By the time I did place a trade, I wasn't necessarily an expert trader, but I knew what I was doing. I felt
Right.
competent, if not expert. That preparation really grounded me in ways that would not have been possible if I had jumped into trading.
Did you did you ever trade on a trading floor? I know that, you've worked with, huge funds and prop firms and all of that. Did you ever trade on a trading floor?
Yeah, I never worked with people actually on the floor. I've worked with people who themselves have had experience making markets on the floor. And that's a very special kind of experience that people bring to trading. But no, I have never worked on the floor myself.
When I left the floor, I had some friends who started electronic trading before I left the floor,
Yep,
and they were not prepared for electronic trading. They lost a lot of money. So when I
correct.
stepped off the floor and decided to learn to try and trade on screen, at least I had the knowledge that they had a very hard time. So I understood it was going to be somewhat of a relearning process. Um,
Yes.
how was that process? How did you handle that with people that did trade on the floor that were continuing to try and trade on screen? Was it a little bit of a different process trying to help them kind of unlearn what they were doing on the floor and relearn what they were doing on screen?
My goodness, yes, a totally different process because on the floor, you knew who the other players were on the floor and you could read their behavior, and those were tells. So it's a lot more like playing live poker. You could read the other players and figure out what they were doing and why they were doing it, and you would see certain people doing certain things, and none of that immediate feel was available online. And so
Hmm.
they had to figure out a different set of patterns to follow to make sense of the market. It was really learning a different activity in a way. And as a result, they had to really go back to being beginners. That's not easy for someone who's an experienced professional to be humble enough to go back and be a beginner. But I would argue that just like the person on the floor had to adapt to trading on the screen, people who have learned markets during non volatile times, during more quiet
Hmm.
times, are now facing a whole different set of conditions with a VIX of 30 plus and need to
Hmm.
go back and observe patterns and become beginners again.
I think it kind of depended on the floor what kind of markets you learned to trade in. If you learned in volatile markets, they seem to have a much more difficult time when things were quiet. People that learned in quiet markets had a harder time when things became more volatile.
Yes, yes. Uh, and over time, you experience enough market conditions that you're more able to make those adaptations. But early in a trader's career, that takes effort. That takes a real uh, preparation.
Yes. A lot of these folks that, stepped out of the pit and tried to learn to trade on screen never even looked at a chart before they tried to do that.
Right.
It was crazy.
Yeah.
A lot of them were just pure scalpers, pure pit scalpers, never looked at a chart, and then they sat down and thought they were going to be able to succeed on screen, which is it's extremely difficult. And, trading at all is extremely difficult, but it's two different games being from the floor to the screen. Thank you for the for the answer there. So Omer's got a. I know you've dealt with this a lot, Doctor. When a trader gets to a profit target that they're trying to reach, whether it's a trading combine, whether it's a specific goal that they're trying to reach, maybe I'm trying to get my account up to $10,000. In my experience, and this was on the trading floor, when I put a profit target, a daily profit target, or anything like that in front of me, when I started getting close to it, that's when the problems started to happen. How do traders when they're getting close to reaching a goal, a positive goal, maintain the mindset like it's just the next trade, and I'll reach it eventually, but I can't push myself to try and reach this goal. And when you get to that close to that glass ceiling, if you will, things tend to blow up a little bit. Can you talk a little bit about that, doctor?
Yeah, and two responses there. One is that the traders I work with who are most successful, they have process goals. They're not, they don't go into a session saying I want to make this amount of money. If the opportunities are there, they feel they can do it, but they
Hmm.
have process goals. Their goals are to trade well. And if there's enough opportunity in the market, and if they trade well, then it's going to show in their P&L. But they're not
Right.
focused on P&L. They're focused on what makes for a good trade, one good trade, another good trade, another good trade, and let the P&L take care of itself. That's very helpful. And in their reviews, they're very process focused. What did I see well? What did I do well? What could I have done better? Rather than focusing on P&L. So
Mhm.
that right away, making that a habit, I think is particularly helpful. The other
And
response I have is a process that we used in Chicago when I worked in Chicago with a market maker in electronic futures. We had a separate P&L target or we kept track of P&L separately, morning, afternoon. So it was like the morning was a day. And then when it was the afternoon, it became a second day. And so you
interesting.
had your goals and you had your activities. And at the end of the first day, which happened at 12 noon, at the end of the
Uh,
first day, you reviewed performance, set your goals, and you started with a fresh P&L and a separate loss limit for your afternoon trading.
Interesting.
So you're turning each day into two trading days, getting a lot more experience. But what that meant was if you were doing well in the morning, then that's banked and you start the afternoon with zero P&L.
No, zero.
And yeah, yeah, you start the afternoon with zero P&L
Fantastic.
and yeah, like it's a new day. And that really helped traders in terms of adjusting to being up or down in the morning.
It's it's ingenious. So simple,
Hmm.
but so impactful, I'm sure.
Yeah, it worked very well.
Huh. Fantastic. All right. I've got a question here from Shubham, who's in the chat quite a bit, asks a lot of questions, very inquisitive. And Shubham, don't ever worry about asking questions. There's no bad
Hmm.
questions. The only bad question is the one that you don't ask. So he's got this question here. As traders, we often reflect on our mistakes, journal them, and make conscious efforts not to repeat them. Yet in moments of pressure, whether it's fear or FOMO or frustration, we often fall into the same patterns we promised ourselves to avoid. Despite our awareness, the behavior repeats. Why does this happen? And how can we rewire these patterns at the subconscious level to create lasting behavioral change? How much time you got, doctor?
Yeah, yeah. So yeah, I can go to the top of the hour.
Just
Yeah,
a lot to unpack in that question.
it's a lot to unpack. Yeah, um, yeah. So what you want to be doing is trading with initially when you're in a developmental phase, trading with such small size that the P&L doesn't matter. What happens is people get these P&L targets in their mind because they want these funded accounts. They want to get more, 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 make more, more, more. And so they become very outcome focused. By taking P&L out of the equation, which is what we were talking about with the doctor's question. By just observing, 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 and practice trading, trading with small size, small size, small size, then the right trades and the right trading become part of us. We internalize those. And once all that is familiar to us, anything that we've done repeatedly, anything that's familiar is not going to bring extreme emotional reactions. It's the attachment to P&L, trading larger than we are prepared for, and having trouble with the P&L swings that creates the emotional conditions.
Um, Doctor, I think a lot of traders probably trade bigger than they're prepared to do mentally, emotionally, so maybe sometimes even physically. Starting small is of course the right thing to do. You've got to create the good habits that are going to continue to pay you over time. How do you suggest increasing your leverage, your trade size over time? I always tell people, going from 1 to 2 contracts is the biggest jump in risk you should ever take,
Mm-hmm.
because it doubles your risk. How would you suggest for traders that are looking to maybe get past their comfort zone a little bit? They've been trading for a while. They've been, making some money. They feel like they're ready to increase their trade size. How would you suggest that they do that and deal with the extra risk mentally?
Yes, and I think you hit it right there that you're going to make those bump ups in sizing incremental. You're going to do it gradually so that the size doesn't feel totally different, and you'll make frequent bumps as you're successful at the lower size, and then you jump to the new size and then you're profitable, jump to the new size, you're profitable. One thing we talked about in the previous session was treating your bumping up of size the way you treat the weights in a gym, that you want to increase the amount of weight that you lift in the gym if you're building your muscular strength, but you
Hmm.
don't go from lifting 100 pounds to lifting 250 pounds. You do it in
Mhm.
small increments. And when you master the first bump up, then you bump it again, and you master that, and you bump it again, and you make it a doable process. Now, if you do it that way, then you're getting success, 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 and that builds confidence, that builds security, and
Good.
takes emotion again out of it.
Thank you, doctor. Well, I think
Absolutely.
we're getting pretty close here. I think we've got maybe time for one more question. Let me find a good one here. Um, there was a one second. You got to find this one. Uh, well, I mean, we talk about this a lot, but why do I keep making mistakes? I know not to make. For example, I'd hit a personal daily loss limit. I know I should stop, but I move my loss limit until I hit the maximum loss limit. Why do I break my own rules? How can I keep from continuing to break them? This is a really common question, a common problem, and maybe a good one to end on.
Yeah, and I would begin by completely taking P&L off the table. That I would trade in simulation mode, and I would follow the rules, follow the rules, follow the rules, and only get back to trading small size once I was consistent in simulation mode. And so by backing up and building the consistency, you prepare yourself to bump up the size in the right way. And those emotional conditions are not going to take over.
Basically, creating better habits through practice.
That's exactly it. And as you create those habits, you internalize those habits, and they become part of you. The other piece I'll just mention is learning from each other. When people have good days, hopefully they share. I mean, that's one of the values of a community. And learning from what other people do well and sharing with others what you do well. And so now you have many more learning lessons per unit time per day and many more things that can move you along in your in your learning curve.
Fantastic. Yes. Everybody lifts each other up that way, right?
Exactly.
Well, Dr. Steenbarger, I can't thank you enough for joining us today. I hope everybody really got a lot out of this. I know I did. We
Well,
really
good.
appreciate you coming and hanging with us for a while. And any last words you want to kind of talk about before we move on?
One thing I've shared in the past: be alert, be alert, be alert to your best trading. At the end of a week, identify your best trades and study, study, study what you did well, because you'll internalize those patterns. You want to learn from your successes. We spend so much time fretting about our mistakes and going over our mistakes. We don't study and internalize what we do well. And so by focusing on our best trading, we become closer and closer to becoming the best trader we can be.
Fantastic, doctor. Yeah, you got to focus on the good things you do, not just the mistakes we make. Well, again,
And
doctor, thank you very much.
early in the coming year, I will have a book coming out called Positive Trading Psychology, and that's going to be a main focus, is how we can learn from our own successes and build on our successes to achieve real success. So I'll be happy to discuss that going forward with everyone.
Oh, definitely, definitely. When does that come out?
Early in 26, like
Early in
February-ish.
26. Okay.
Correct.
All right. I'm gonna order it on Amazon pre-order right now if it's on
Okay. Okay.
there.
Well, thanks so much, Hoag. Really appreciate it.
We appreciate you so much, Dr. Steenbarger. Have a great rest of the day. Be careful out there. It's a rough market
Really
these days.
good luck with these markets. Okay. Thanks.